Welcome back to the Isn't That Rich podcast. I'm your host, Ashley McVicker.
And I'm your host, Jill Franks. And today's guest is Ryan Masterson. He's a CPA with Kemper CPA Group and works closely with small business owners, helping them tackle everything from tricky tax situations to buying, selling, or passing on their business. So Ryan graduated from SIU Carbondale with both his bachelor's and master's degree in accountancy, and he's picked up some serious credentials along the way. He's a certified valuation analyst, a certified fraud examiner. And he's accredited in business valuation, which is what we're going to be talking about mostly today. So basically anything you need to know about your business, what it's worth, or how to plan for what's next, Ryan's your guy. So we're really interested in talking with you today. So thank you for being here, Ryan.
Yeah, thanks for having me.
Yeah, Ryan, so let's just get started. Tell us a little bit about yourself and then the work you're doing right now.
Sure. So, like you said, I'm by training, I'm an accountant. I'm a CPA, and then I have additional training and credentials in the area of business valuation. Basically, what I do with those is, or kind of on a daily basis, is try to help my clients, whether it's tax consulting or business valuations, really plan long-term for the future and then try to execute the plans to achieve whatever their goals are. So,
yeah. And we just actually recorded an episode maybe last month with our insurance agency, and they talked all about key person insurance. And they brought up that in order to get a key person insurance policy, you had to do a business valuation. And that kind of got us thinking we need to talk to somebody who knows all about this business valuation and what that's all about. So that kind of brought us to this interview. And so I'm excited to dive in a little bit more about what a business valuation is. So could you explain maybe for a business owner who, is looking to either buy, sell, what is about business valuation? What does that mean?
Sure. So the business valuation is really valuing the enterprise, right? So the entity as a whole. And so if we think about that, assuming that we're profitable, it's the value of the entirety and the idea that that's maybe worth something more or producing more cash flow than maybe just the value of the underlying parts that you can identify, right? So we can walk around, we could look at inventory items, we could count those, we could see what your cash, accounts receivable, accounts payable are on your balance sheet, and we could see what, maybe your tangible equipment and those things are worth, but a lot of times it's worth something in excess of that because we're producing additional cash flows beyond what a reasonable rate of return on those tangible and identifiable intangible assets. And so what we're trying to target is what is it in the entirety, right? So that's the question mark.
Yeah. And I always think about this, like, people just like in their homes and their businesses, they probably think, oh, it's worth this amount, but it really takes somebody to dig deep and look at everything, like you said in an entirety to really figure out what that's worth.
Sure. Yeah. There's no crystal ball. It's methodic. And there are accepted methods for doing that. Right. So, there are tools that we use, comparisons, and just calculations, around that. Yeah.
Cool.
So what's the biggest factor that determines what a business is worth, or factors, I guess, not just one?
So there are numerous, but probably if we wanted to boil those down to a couple of things, the first is cash flow, right? So if we don't have cash flow, it might be a liquidation value, right? Which would revert back to what are our tangible items worth if we were to liquidate those, right? But assuming we have excess cash flow, that would be item number one. And then the second part is risk, right? And so what risks are associated with those cash flows, and how do we translate that into kind of like a rate of return? If we nail down the cash flows and we thought about it kind of like an annuity, right? So an annuity, you usually have some amount of payments over time. Those are known if you just purchased it from, say, a financial advisor, and baked into that is some rate of return, right? And so those cash flows are known. There's a fair amount of certainty to those, and there may be a low, maybe 5 or 6% rate of return on an annuity. The difference from a business perspective, if I'm buying or selling it, what I'm really buying is the right to those future earnings and cash flows, right? The difference between that and an annuity is I've got a lot more risk that my payments won't be even, or that they could be better, but they also might be worse. And I don't know what periods those will occur in. And so more risk usually means a higher rate of return that's required, which just means I need the potential to maybe earn more to accept the volatility in those cash flows, right? Or the likelihood that I might not get them all. Okay. So cash flow and risk, right? Yeah. Nailing those down. What do we think those are going to be if I was going to buy those out into the future?
So I guess that's what I was going to say was, if you look at both of those, you're doing a business valuation. So looking at those, it could be worth less or worth more.
True.
Yes. Right.
Yeah.
Okay. Got it.
So this is something. So actually we'll talk about this just because it's a example that comes to mind. Say I owned a coffee shop and I was looking to get out of owning this coffee shop and I was going to sell my portion of that. Can I do a business valuation on my own? Is that something you recommend doing on your own? Is that a reasonable, I can look around and, get on what is a buy sell biz and see what local coffee shops are going for and maybe do my own market. Is that something you would recommend doing on someone's own?
I wouldn't recommend that. Not just to be not just to be self-serving for the work that I do, but then I would even take that a step further and say that most of the industries that anybody is operating in, there are oftentimes maybe rule of thumb, multiples, or ways that they may use as kind of like rules of thumb to exchange interests. And so a lot of times people may hear about those things from other people they know in the industry. That's common. It might be a multiple of, say, EBITDA or a percentage of revenue, plus inventory, or some other function that someone has came up as kind of a quick math way to calculate values. And so when you think about those are based on industry averages, right? That somebody has came up with within that industry. And so by coincidence, someone might use those and apply it to their company, and they might come up with a correct value, assuming that everything in their financials and how they operate is average with the industry.
Right.
Which is almost no one.
Yeah.
Right. And so the problem with that is if you're the person selling your coffee shop, you only have one coffee shop to sell. Yeah. And that's a permanent difference. You're going to get one check one time. Right. And so if you miscalculate that by 5%, there's no getting it back. Yeah. Right. On the flip side of it, which is probably more likely, somehow if people calculate their own, they typically come up with a higher value.
Yeah, they'd inflate those.
Right. And so in doing that, you may have missed a buyer that was legitimate because you were just simply asking too much and weren't informed. So you didn't have all the information available, and those would be the reasons why.
Yeah, you'd want to work with somebody who knows what they're doing, can find out that information.
Yeah, to get you the right buyer and the right price.
And it's objective, right?
Definitely. So I want to talk a little bit about, so a lot of our people that we work with, we see customers all the time, they're getting towards retirement age, they're looking to sell their business, or we're working with younger people, they're getting ready to buy something, they're excited, they're these younger entrepreneurs, right? So if you're looking to sell a business, at what point should a business owner start thinking about getting their business valued?
So at the point you've contemplated it, that's probably a good time, right? And hopefully that might be, whether you're selling, or I usually say transitioning, right? Because we don't know, what form is that going to take, right? But ideally it would be at least 5 years. A lot of times it's not. Right. But the more time you have available when you're contemplating that, the more time you have to consider the issues or risks that might be identified when we do evaluation, so that you can make changes to some of those, help mitigate them, right? And make sure that you're getting the most for your money, right? The closer you get to the date you want to exit, it's still a good idea to go ahead and do a valuation of some capacity, but your opportunity for changing that becomes less the closer you get to that date because you don't have enough time.
Yeah.
You just sparked something for me when you said exit. So is the only time to consider getting a business valuation when you're thinking about leaving? I know you just said like, well, it's whenever you think of it, but are there other times besides if you're not going to leave the business that you should get a business valuation?
Sure. Absolutely. So you mentioned earlier, the insurance issue with key employees, right? Yes. So in that scenario, the question is, well, how much are we really at risk for this key employee of losing, right? And so an example a way that you might determine that would be prepare 2 scenarios of evaluation of the company with and without that person, changes to the cash flow that might happen without that person. And the difference between the two is probably an example of what level of insurance you might need. If we thought about kind of the beginning of a business to the end, times that we might need evaluation. So in the beginning, oftentimes we might have shareholder or partner agreements where entities agree to, if something happens to one or the other of the owners, that we're going to buy out their interests. And so usually those are funded, if not entirely, at least in some part or a down payment amount by insurance, right? Okay. And so when you're doing that, you have to be able to answer that question of how much do I need, right? And so that's a time. So if you're looking at an operating agreement or you have a shareholder or partner agreement, buyout agreements, things like that you're wanting to put in place with people you own the company with, that's a great time. When somebody's thinking about estate planning, right? More times than not, probably the single largest asset anybody has in all of that planning is an unknown value, which is their business until you do that, right? And so a lot of times you need to know what that value is, particularly where you have spouses, right? A lot of times we try to even the buckets for estate tax reasons between the spouses. And to do that, you can't always just move shares of an entity, depending on what it is, from one spouse to another. So you have to even up with other assets, but you can't do that if you don't know what it is, right?
Right.
So that's a time. And then, so when someone's thinking about estate planning, that kind of thing, and maybe someone has an unsolicited offer, right? So somebody has came to me with this, is this legitimate? Right.
You don't want to
consider it.
Accept a lowball offer if your business is worth so much more, or vice versa.
Right.
I mean, you could be
and
right. It's like Russian roulette. We don't know.
Yeah. And planning just kind of long-term for retirement or whatever your other plan is after. I mean, so those are all times that, and actually beyond that, if you have exchanges of interest, right? So are you buying another partner out or shareholder or is someone new coming in, right? That maybe has worked there and you're going to sell or finance part of it or go to the bank for part of it. Well, if you're going to do that, you need some proof of why you think something's worth what it is, right? Will it cash flow? And so you can answer those questions. And for someone that might be coming in, there's kind of some reassurance that if they're not accustomed to being an owner, that you've done some due diligence and didn't just make up a number to try and sell them something. Yeah. Right. So you can generate some buy-in from that too.
Yeah. So if you're looking for investors to buy into your company or you're looking for a new partner, those are all really good ways. I didn't think about the one you're getting in, you need it for an operating agreement.
That's a good idea.
Yeah.
And it also gives you an opportunity potentially to use that to possibly consider formulas in your operating agreement in some scenarios where a buyout might be triggered in the agreement, right? So you might be able to avoid potentially evaluation in the future because you've set some kind of formula for a given scenario. Sometimes that's a good answer, sometimes not, but it at least gives you the opportunity.
Okay. What do you mean by formula?
So, so we don't know what the value will be when X event happens.
Yeah.
Right. Death, divorce,
Anything.
somebody's dissociated with the company. Any of those things happen. But if we knew what the value is today and we can tie that to some metric in the company and use a formula that might be appropriate for some of those situations, that's an opportunity to make things easier to calculate in the future, or transition more smooth, right? Okay. So it doesn't fit all scenarios, but there are times when that's an okay option.
And so you do that to not have to do the valuation again? Is that what you're saying?
Ease of transition, okay, right, in the future.
Okay.
So if you decided to quit and you were my partner, I don't really want to incur a tremendous amount of administrative costs in the future because you decided to take another job. That mm-hmm. wasn't really my fault. I'm still here, mm-hmm. right? And so it might be, here's the formula that we'll use. We've all agreed on it, and this is what it is. So, but that needs to be based on some basis.
So like your revenue or your cash flow.
Yeah.
At that time.
And that doesn't fit every entity, but there are a lot of times it may be appropriate, and it might not be appropriate if someone passed away versus mm-hmm. if it was just an internal transaction and I decided that I wanted out today. Right.
Yeah, that makes sense. Got it. So what are some early steps a business owner? So it's 5 years out from when I'm wanting to sell this business. What are some early steps that a business owner can take if they want to position their business to sell in the next few years?
So I think I mentioned earlier just a little bit that there's a lot of, there are almost trade groups for every industry, right? And in those, if you're a member, if you're not and you're in an industry, you should be probably, but there's usually a lot of financial information around those, right? So you may be able to find out what are norms besides just what is the norm in your company, mm-hmm. right? And so something that you can always do, even if you're not thinking about valuations, that's a good practice, is benchmark yourself against people in the industry and what the norms are. Because ultimately, at the end of the day, that's what your competitor is going to measure you against if they're acquiring you or myself or someone else, mm-hmm. right? So to the extent that you can be normal, there are risks with being an underperformer, right? Mm-hmm. And so we would usually think about that as being like a lower margin, leaner, maybe operating, or I guess too heavy, but so not producing enough cash flow. There's also risks if you think about it with someone that's producing margins wildly outside of what the industry might be, mm-hmm. and maybe they're doing that because they work all their employees overtime 70 hours a week. And so if I'm looking at that, a risk might be, if I acquire this, what's the probability of these people bailing because we've been working 70 hours a week for the last mm-hmm. 3 years, right? It generated a good temporary financial answer. It's probably not a good long-term answer, even though it looks really good on paper, right? Yeah. So things that you to the extent you can compare to the industry is it's always a good analysis to do.
Yeah, so you can join these different groups and compare yourself.
Yeah, whatever exists for what you're doing.
Yeah. So my little beneficial coffee shop, I can compare others.
Sure.
Join something.
Yeah. Or even just a group of restaurants, right?
Yeah.
So they're trade organizations for almost anything.
Gotcha.
This is like kind of a off the wall, not really off the wall question, but I'm thinking about like this coffee shop. And so if you compared Jill's little mom and pop coffee shop to our local Starbucks, mm-hmm. in terms of like comps, I guess is the word I use. I've watched HGTV, so I use comps. Do you compare the two? Because that's like a gigantic franchise and hers is but they're in the same market. They're both in Marion. So in that example, what that would be called in business valuation, where that's like a sales comparison and mm-hmm. you're talking about real estate, mm-hmm. kind of the comparable example of that will apply is called a market approach. And so what that amounts to is we'll pull down private company transactions from databases we subscribe to. So there's thousands of transactions, and we'll narrow those down based on the industry of what people are in. And we'll try to find,
what we think is a reasonable sample group of those companies and narrow them down based on their financial characteristics. So we'll get information about those companies of what they sold for, what the, kind of the terms of the transactions were, and then actual financial data kind of in detail. If you thought about like a balance sheet, income statement, statement of cash flow, those types of information, where it was at, and like this and the sale date. And so what we'll do with that, like in, when you're talking about an easy comparison, I think people can relate to is this building may have sold for X dollars per square foot, right? And so I could come out and look at this and say, okay, I know that it sold in the last 6 months for X dollars a square foot. Maybe your real estate appraiser would say, this is very similar to your building. And so we're going to apply that same per square footage rate to your building, and that might be the value under that example on that building, right? So it's somewhat similar when we look at all those comparable companies, in that we'll calculate like financial, like multiples or percentage of revenue and different financial characteristics about those transactions as a group. And then we'll try to apply it to our company, right? So I may know what an EBITDA multiple is from those samples of companies.
EBITDA.
Yeah, so
I'm like, you must really know math.
EBITDA is it's earnings before interest, taxes, depreciation, and amortization. So that's used a lot of times is like as a proxy for cash flow is what it's trying to approximate, right? And so, but we can calculate that multiple that removes the impact of like what is the tax structure of the entity, what's their financing structure like, and what was the CapEx that they kind of maybe purchased just discretionarily, right? And so we can calculate a multiple based on those actual transactions and then apply it to our company, kind of like a square footage basis, right? Okay. The problem with those transactions that you can have sometimes is, unlike the building where someone could come and walk around and actually physically see the thing, there could always be things that we may not know in those market transactions that you just can't see in the, even as much data as we get around those, that you may not know exist. So like as an example did somebody wait till the last minute and had to have a fire sale because they decided they were going to retire, right? Did somebody die? Was there a key employee issue? There's just a lot of information that you can't go kick the tires, right? And so that's why we try to find a decent sized sample group to get rid of some of that noise, right? And then look at the sample as a whole, but it's the same general concept. And that would be another method, right? Cash flow still drives it because you have to have EBITDA or seller discretionary cash flow or some number of cash flow, but you just use a multiple instead of like a rate of return. Okay. So.
Yeah. So I think EBITDA, yeah. No, but when you're comparing, I think a Starbucks would be kind of outside that perimeter, comparing a small coffee shop.
Right, like you would do more of the other mom and pops in the area first.
Yeah, or even outside the area in similar areas. Is that kind of what you were getting at too? Like if you could pull samples.
Yeah, to the extent you can find something closer in the area or more similar based on like the financial characteristics of how you're operating, right? And so that might mean revenue or what your margins are or just sheer dollars. So it's kind of all in. But sure, something else might be more comparable. That might still support other methods potentially, right? If you didn't have any other comparison, that might be something that you might not rely on, but you might at least look at it, right? Because it should be in a range.
Sure.
Or can you reconcile it back, right?
It sounds complicated, so I'm definitely not doing a business valuation myself. Now it's completely out of the question after talking with you even just for 10 minutes. But so if this seller, so selling the business, same person, 5 years, what are some common mistakes you see these owners make when they start this business valuation process?
So probably not starting, right? It's easy to think about things and not take action, right? So not, and really what does starting mean? It really just means starting the conversation, right? Because you can always go do something from there. I mean, that's really it's probably the biggest mistake. And it happens all the time because I will do valuations every year for somebody that's has never done anything like that. And they're wanting to either retire or they have somebody wanting to buy it and they're ready to get out. And the timeline on that is probably not a year, right? It's something short term. How fast can you do this?
Right.
And it's just, like I said before, it's just less opportunity to make changes that would be to your benefit, right?
Right.
If we all knew what those were, of course we'd do whatever we could to change them. Yeah. You have to know what it is.
I'm sure the timeline changes on this, but depending on how large or small the business is, but how long typically does it take you to do a business valuation for a company?
It depends on the backlog. So like the timeline of actually completing it might be like 6 to 8 weeks. And I'm not necessarily because I'm working on that one the whole time. It's just you have others going on continuously. And then there's a process of gathering information, going through it, following back up with questions, reviewing projections, and actually preparing reports that take some time. And so it can be a little bit of a start and stop activity. And sometimes it could be longer if you're to the extent we're waiting for more information we've asked for. And sometimes it takes a while to come up with. It could take longer. That's a good activity though, because when someone is getting ready to sell, right, if somebody actually has an offer, they're going to go through due diligence, and much of the information that we would have requested from them previously that took them maybe a while to get together because they didn't just have it at hand, they will be used to actually producing it. They'll know what somebody's asking for, so it won't necessarily be a foreign thing. And that won't be true for everything somebody would ask for, but for a lot of it, and at least like a lot of the financial part, it would be.
Yeah, I feel like that's the same thing we go through at the bank. You know, Polly one of our mortgage officers, she always complains. She's like, I could get this done so fast, but I'm waiting on information from my seller or my buyers and getting my income statements and all this stuff. So I'm sure with your process, that takes a lot of time too. So every situation is probably different. So probably a lot of waiting on information for you.
If someone was preparing to do a business valuation, what are some of the, financial paperwork they need to gather to start preparing to give to you? And maybe you can't even list it all. I don't know, but
yeah, it's kind of a long list, and I think it depends on what you're doing.
Yeah. Right.
So that's kind of a custom thing. But some of those items would be, like customer lists over multiple years to kind of see what kind of concentrations we might have. Similarly, maybe vendors, employee information, right? So that could be financial and non-financial, right? So if you thought about what's like our employee turnover, what's the longevity of those people, how much is left in the tank, right? Just a lot of things like that. Agreements, right? Are you keeping minutes? Company, we may ask for those sometimes.
That's interesting that you say the customer list, because you could look at that, and if you notice year over year you had less customers.
Or what's the churn, right? Depending on what you're doing. What's your concentration? Do you have 3 or 30?
Very interesting.
So many details, and that's not excluding like all of the, like you said, the tangible things, like the equipment a building might have, or all that stuff as well. So
I know I'm sitting here thinking about my parents and like
all the things they have.
I'm like, does he have to go out and find all these dumpsters? This is how much this one's worth. This is how much this is worth. Like
probably,
And kind of along those lines, even relevant equipment lists, right? Everybody has a depreciation schedule. A lot of times things are not removed off of those, even though we junked it 5 years ago, right? And so keeping that stuff current and relevant, that's important, even like for insurance reasons, right? So you need to have those lists with insurance, but you need to maintain both of those and keep them active. Just as a good practice. But
I'm curious to know. So a lot of businesses, they rely on a certain few people. Does it increase the value of your business? And you might I don't know, this might be a weird question. Does it increase the value of your business if you have a lot of processes and procedures in place, written down, easy to transfer? You know what I mean? Like,
Sure.
so
Right. I get what you mean.
you know,
Yeah.
somebody can come in
So-
and they have everything written down. They can easily see this is how you do things.
So when we're thinking about risk,
Yeah.
right? A risk would be, I own a business and Jill does X activity at my business and everything she does is stored in her head.
Yeah.
Right.
Like maybe even all her passwords and they're just
Or the
everything.
recipe, like a recipe or something.
What I
Yeah.
do on a regular basis, I know it's Thursday and here's what I do, right? But what if you become disgruntled, leave, find a better job, pass away, all those things that happen, to the extent that you can have those kinds of things documented, that's a good argument for less risk, right? And it's just more marketable. So you can that's a way to help mitigate, maybe if you were a key employee, right? That somebody would at least have a roadmap if you had kind of some instructions or almost like a manual for whatever that position was, with what you did, when you did it, how do you access the information? So
Yes.
yeah, it's a mitigating factor. It's probably not going to make it all up.
Yeah.
Right. But it helps.
Yeah. So you could argue if maybe that would be one or two of the things you could do if you are preparing to sell, would be to get some of that
Sure.
stuff out of, if you're that person, that owner who knows the
Right.
recipe.
Really just
or
if you're
whatever.
existing.
Yeah.
Right. There's no one will be harmed
Yeah.
by you having good documentation about what your processes are.
Yeah.
And that also gives you leverage, because to the extent you do that, you can leverage more people to spread those duties out and just further mitigate that over time. There's no downside.
Right. Yeah. Good.
What should someone looking to buy a business be paying close attention to during the valuation process?
So I would say, kind of going back to like industry comparisons, right? So that's part of what we will do. Looking at those and seeing if we're out of step somewhere from the other people. The first question is, well, why? Right? Is that something we can change? Or how do we change it? Right? And then other things that we might think about are like key employees, right? So that's an easy one to pick on, but what are ways that we can mitigate that? So can we assign some of the duties to other people? Maybe we do rotations on activities. Maybe we need more people helping with that position, but we really just, maybe we don't want to spend the money to have the extra staff person. And the question is, can you really afford not to, right? We can't afford not to buy insurance a lot of times. And that's kind of what you're doing in some of those situations. We'll make, as part of that, to make the historical financials comparable with projections that we do, we'll make what are called normalizing adjustments. And so that's really, it's really to kind of remove the effect of things that might be discretionary or one time, so that we can compare those historical financials with those that we project to see if they're reasonable, really, right? But when you look at some of those normalizing adjustments, for instance, we'll do salary surveys a lot of times that might apply to owners or key employees, right? So we may adjust to the extent it's an owner, up or down. That may not have a huge impact on it. But let's say that you had an owner that was working 3,000 hours a year, right? And that might be many people. That's not really appealing to me as a buyer to buy a company if I have to work 3,000 hours a year.
Yeah, because now you're the operator,
Right.
And that's maybe not be
So-
what you're looking for,
Right. So so how do we mitigate? How can you mitigate that? Right. Well, delegate a little. That's hard to do, and that may mean you may need some more people, but you're closer maybe to an absentee type situation where even if you aren't able to sell, maybe it could more easily run without you physically there every day, and you could live with it. So you have a backup plan, and you still have pretty good cash flow, right? So those things kind of can all work together. But anytime we have normalizing adjustments or variances from the industry, those are all things that we could work on. but it takes time.
So have you ever done a business valuation and I don't know, if you're like, this is not a good business, and then someone's buying the business and they're like, I can look at this business valuation and tell I should not buy this business. Right. You know what I'm saying? 'Cause like maybe not all business valuations are good. Maybe the business isn't good. It's not profitable.
Sure. So a lot of times I might be working with a seller. A lot of times we're working with a buyer. And, sometimes the best deals you get are maybe the bad deals you didn't take.
Right.
Right.
Yeah.
Yeah.
And so, sure. And a lot of times that's not necessarily, this is terrible, we shouldn't do this. It's probably more of a discussion around, here are the things we found. Yeah. These are the concerns we have. Here's how we think this impacts the value. And then the person that is selling maybe says, well, okay, I understand that, or we can try to negotiate around that, or they're just out. Yeah. And we say, well, maybe we'll talk to you again later, but you need to fix those things if you want what you want.
Well, right? Or I'm thinking like if you're a buyer and you get this business valuation and you're like, I think I could really maybe improve these parts of a business. That's also an opportunity to look at.
Sure. So, and so in the buyer seat, if I'm working with them, the seller may or may not know, and this kind of goes back to preparing your own numbers, right? If you're the seller in a situation, the buyer, if it's anything sizable, more likely than not has someone like me that's looking at the information with them, and they may never tell you that, or they may have done so many transactions that they kind of have enough internal skills and knowledge that they know what's reasonable with whatever the widget is they're buying, right? And so if I prepare a valuation for them, for your company that they're buying, chances are if that's a lot better than what you're asking, they're probably not going to tell you. And so you're not ever going to know. Right. And if there's anything that's maybe not as positive, they're probably going to try to negotiate with you on that. And so that's kind of like the risk of that permanence, that it's a one-time transaction. Can you really afford not to do that for what you might have at risk? Because you're never going to know. It's going to be a question mark. Yeah. If you don't do that.
Well, that was kind of my next question is like, so how does this, who hires you for the business valuation? Is it the seller? Is it the buyer? Do they come together and hire you together and say, we both get to see this business valuation? Because I mean, obviously you would want one on both sides. But
usually it's one or the other if it's outside parties.
Okay.
Right. So, and they may, the buyer or the seller may or may not choose to share that with the other party. And that's kind of up to them. It's their information. And now a difference would be, say that we're trying to transition to someone internally, right? And that might be a situation where you really are kind of in a neutral seat and everybody's looking at it and they're really just trying to be amicable and treat everybody fairly and get something that will cash flow over time. So then basically actually pay for itself, right? A lot of times in those internal transactions, the person buying's not independently wealthy. And so they can't just write a check. It may be difficult to get financing for the entirety of everything. And so usually some part of it has to be seller financed. And we have to kind of work around part of that.
Yeah, that makes sense.
Do you have an example? I know you probably obviously cannot name a company, but have you done a business valuation for a company that they maybe thought it was going to come back at a certain number and then you came back and it was like way higher and they were just super excited? He's like, he's like, no. Or just maybe even just a little bit better than.
Or maybe just unexpected results in general.
Yeah. Yes.
Right?
Yes. Higher or lower.
Yeah. So I think a lot of times it may be a little bit one or the other. And many times a lot of people that are involved in the operations and are maybe more savvy, maybe have some relative idea of what they think it would be. A lot of times when I do those, at the end of it, someone might say, well, here's what I was using kind of in my own mind, right? Or like on the back of the napkin, as where I thought we were. And so sometimes that's close. Sometimes it's could be 10 or 20% off, right? Or, and that's still, I would say, pretty close if you didn't do everything we did. So yeah, that happens. I think more times than not.
Are they disappointed?
Well, I was going to say it's probably more frequent that my used car is worth more because I drove it.
Right.
There's an emotional, they have that emotional tie to it.
But not always. There are absolutely people that kind of undervalue and don't realize what they've been doing. And a lot of times that's because, maybe they've been very conservative and they haven't, they've just operated conservatively and haven't maybe even individually realized as much of the cash flow, and they've just reinvested it forever. Yeah. So, it could go both ways, I would say. But
yeah, how do you handle that emotional seller who thinks they're, do they haggle with you, or do they try to get you to, come up on it? People that are really emotional and they are disappointed with the results. How do you handle that?
So I think going through the process, usually that's like by the time that we're at the end of it, I don't think that's usually the scenario that we've walked through the process. We've prepared projections together and reviewed them in detail, like line item by line item of what they think they're going to do. And whether we used a market approach or an income approach where we basically took a present value of those cash flows, however that works out, I think by the time we're at the end of it and we walk through what it is, I think there's some level of understanding more than if on day one I said, this is worth X, which I wouldn't know. But I think at that point, I think there's some more understanding. And I don't think that's usually
so you kind of manage it through the process rather than just here's your results and it is what it is.
And so people, even though people don't prepare business valuations, they're intelligent people, right? And if you explain things and go through the process, I think they may not understand the actual math of how you do a present value formula or couldn't recite it, and that's okay, but they understand the concept. And so there's a lot of value in having that explanation and the understanding that helps you reconcile some of that.
Yeah. Okay. So a company has this business valuation done, and maybe it's just because it was at the beginning during their operating agreement, and now 10 years have gone by and things have changed in the business. How often does somebody need to do a business valuation?
Sure. So, and the answer to that would be, when is it valuable to us? I would say it would be of value to us when there's been, if there's either a pending or some kind of event that has happened, something's changed materially, right? If I've used that as part of my estate plan, usually people, I think, need to review those every 3 to 5 years and the documents and what's happened, because like we said before, there may be different buckets. We've channeled those buckets to maybe go to particular people or for particular purposes in our estate plan. And to the extent those values change, that might change our plan, and we may need to reconsider or rebalance what we're doing, right? And so in a span of years, or when there's some kind of an event, or if we're contemplating, maybe we did something 10 years ago, but now we're actually at the point we've tried to manage some of our risks. We've tried to grow and whatever the plans were we made. And now we know that, maybe we're 5 years or a couple years out from actually completing whatever it was we planned, whether it was a transition to somebody internally, a sale to somebody outside, a competitor, or whatever it was. Yeah. When is there an event, or just the passage of time, or just it's valuable to me to have information available about my company, because there's not a ticker going across with the value on it daily. And it's good to have an objective view around how I'm performing compared to others in the industry, right? That gives you that, right? So information's power. And everybody would agree, including myself, that I wish I knew 5 or 10 or 20 years ago what I knew today, right? And so if it's the year before something's going to happen, you'll probably really wish you knew that 5 or 10 years prior. And that's true with that too. There's just more information.
Yeah. So you would say, maybe I have 3 coffee shops now, 5 coffee shops now. It's time to get a new evaluation or valuation.
Sure. Yeah. Right. So your overhead's different, right?
Yeah.
You still have one administrative office. You might be running one payroll. And so you've scaled up somewhat and spread out your overhead. So you're probably doing a little better. And there's probably a better market for someone with 3 coffee shops than 1 coffee shop where you have to make the espressos.
Right.
Right.
Mm-hmm. Yeah.
Many people might like to own a coffee shop and manage it. They might not like actually making coffee.
Yeah.
Right?
What's one piece of advice you'd give to a business owner today who isn't sure what their business is worth?
Start a conversation, right? So just like we said before, what's the mistake that you could make? And that's to do nothing. And so have a conversation. And that could be with, the people that you need to be in contact with, or a financial advisor. You need like your CPA and an attorney. And those people that you need those solid relationships with, because it's going to, whatever you do for the duration is those people are going to have input that can be good advice for you. Right. And business valuation is a part of that. But it's all kind of one ball of yarn really together. And so start a conversation with any of those people, or reach out to me, or somebody that does something similar. Right. And those are easy conversations to have. I'm pretty transparent. And if I think that you don't need something, I'll tell you. Right. So.
Okay. So if people want to get in touch with you and they want to do a business valuation, how do they do that?
Sure. So you can look me up on our website. It's KemperCPA.com. So you search Ryan Masterson, or you could email me at rmasterson@KemperCPA.com anytime.
Okay. Perfect. And where are you located out of, Ryan?
I work in Evansville, Indiana, and Mount Carmel, Illinois. So you can find me in either of those places or anywhere in between.
Great. Well, I've enjoyed this conversation. Thank you for being here this morning.
Yeah, thank
Thanks.
you.
Yeah, thank you so much. And hopefully this has shed some light on those of our listeners who are looking to either sell their business or find out what it's worth, and just give them a little more information. So thank you so much.
Welcome.
Thanks for listening. We'll see you next week.
So Jill, where do we go from here?
Be sure to check out our show notes for this episode, and also be sure to follow us on social media and subscribe to our newsletter. And we'll see you next week.
See you next week.